All right, hello everyone, and welcome to the NinjaTrader Ecosystem webinar room. Before we kick off this event, I do want to take a moment to test for picture and sound. If you can clearly hear my voice and see the projection in the room, please do type a Y in the chat box right now. All right, I'm getting some confirmations. Thanks to the folks that are confirming that, and I want to thank everyone for joining us today. My name is Jared Meyer, and I work for NinjaTrader in our Denver office. I'm pleased to be hosting this very special event with Stewart Solaka of Chicagostock Trading. And just to kick things off, I want to do a quick poll. So if you would just choose number 1, 2, 3, or 4, this is a question just asking what types of tools or services have you used from the NinjaTrader ecosystem. While you fill that out, I do want to mention it is important to understand that there are substantial risks in trading commodities, futures, contracts, and Forex. You should carefully consider whether such trading is suitable for you, and that will depend on your specific circumstances and financial resources. It is possible to lose all the funds deposited with your broker, and you could even incur losses beyond these amounts. Please inquire at the link I'm going to post in the room right now for more information or for a copy of the CFTC full risk disclosure. Also, please remember that these trading webinars are not a solicitation or recommendation, but simply educational in nature. All right, a couple other reminders that this presentation is brought to you by NinjaTrader LLC, which is a technology company responsible for developing and supporting the NinjaTrader trading software. Brokerage-related questions should be directed to NinjaTrader Brokerage directly at 312-262-1289 or by emailing brokerage.sales@ninjatrader.com. I'm going to pop that into the chat here in case you have interest in using that information. All right, thanks everyone for filling out that poll. I'm going to go over the results here for just a moment. I'm just going to start from the top. Oops, excuse me. I did put in the wrong poll. I'm going to give everyone a new poll. Apologies for that. Give me 1 second, and then I'm going to have you fill out this other poll. I had the wrong one up. Please, apologies on that one. Let's see here. I want to see. There we go. All right. So if you want to fill out that poll real quick, and while you do that, I want to tell you about a couple extra things. NinjaTrader does have new tools added nearly every day. Our ecosystem is home to hundreds of apps and services. You can quickly and easily find the tools and services you're looking for with a simple keyword search. You also find information about upcoming webinars and on-demand video archive to view event recordings. Also, for those of you that are active on social media, please do follow us or like us for the best way to get more information. I'm going to put that in here too. So our Facebook as well as our Twitter handle. All right. And a couple other things. NinjaTrader is always free for advanced charting, strategy, backtesting, and trade simulation. To ensure you're on the latest version of NinjaTrader and pick up a free live data trial, please visit the following link. Get that over here. All right. And of course, you can purchase or lease NinjaTrader from this link I'm going to put in the room as well. This is just information for those of you who are maybe new to us or haven't seen this information before. And finally, if you're just getting started with NinjaTrader, we offer free live training on a daily basis. You can view a schedule of our weekly webinars at this next link I'm going to post in the room here. So I'm just going to go over the poll results very quickly. About a third of you are here have used indicators and strategies from us before, so that's fantastic from our vendors there. About 50% of folks here have gotten education services, and almost half of you have not used any services from the ecosystem. I encourage you to check it out. There's a link in that series I provided. I'm going to close this out for everyone now. And just to moving right along, we are very excited for this unique event in which Stewart Solaka discusses how to apply intraday and 3-day pivots and ranges to your trading methodology. Thanks again for your attendance today. Without further ado, it is my pleasure to welcome to the NinjaTrader Ecosystem webinar room, Stewart Solaka. Please take it away, Stewart.
All right, good afternoon. Thank you, Jared. Thank you for that introduction. Just do a sound check. Can everyone hear the sound and audio? All right, thank you very much for confirming that. Once again, thanks Jared for your introduction. I want to thank NinjaTrader for giving this opportunity and sponsoring this event so that we can go through this information. And we're going to look at volatility windows and pivots today, how to apply those, and how I apply those to charts, and just kind of learn more about those. So without further ado, we will begin. And so in this webinar, we will review the market feeling, use, and guidance of volatility windows combined with pivot levels. Two types of volatility windows we look at is an intraday basis, which is used for that day, which is mostly for day trading, and on a 6-month basis, which is used for macro trading, and this is used based off of the first 6 months of the year and the second half of the year, or the second 6 months of the year. And two types of pivots, intraday pivots. Again, we apply those on short time frames, 10, 5-minute charts, but we're looking at pivots from the prior session for that day, and 3-day pivots. These are just two of the many pivots, but these are the two main ones that I follow and look at, and what we're going to go over today. So two types of pivots again, the intraday pivot, which is based off of the previous cash trading session. It helps to identify support and resistance, and I like to plot these on my 5 and 10-minute charts or whatever short time frame I'm looking at, because they'll give me the area of support or resistance from the prior session for that day. You can see on this 10-minute chart, usually plot them in dotted horizontal lines that can give me a visual of where the pivots are. The 3-day pivots are plotted. I plot them on a 30 and a 60-minute chart, and they're based off of data from the past 3 trading sessions. So these are good for if you're seeing a momentum or a trend in the market. These account for data from the last 3 days, so they have a little bit more weight to them. So if you have a 3-day pivot that's below the market and an intraday that's above the market, those 3-day pivots will be stronger support since it's based off of data from the last 3 days, and it's most likely given an area of to try to defend that trend. So we use a range above and below the pivot, and the range tells us whether the prior day, if it was a volatile session, the range will be wider. It means we should see more consolidation and or more chop. If you have a narrow pivot range, that gives an indication that the prior session or sessions that it's based off of was very indecisive, and it's like having a rubber band stretched out that could give way for volatility to expand and or break out of a range. So think of a compressed market that's indecisive. You'll see those when the pivots tightened up. So when they do tighten up like that, they give way an opportunity to try to see an expansion of the range or a breakout. From my experience, a lot of the tight pivots give way to breakouts, but they also have kind of lean towards the downside, because usually volatility expands mostly when markets break down. But we have seen a couple of breaks to the upside, especially this year when the market's kind of tightened up and you get a breakout to the upside. So we'll look at a lot of different examples, and we'll look at those as well. Next thing is the volatility windows, and these are windows proprietary based off of the opening, the cash open. And I encourage questions throughout just to get this. If I'm going too fast or too slow, let me know. But we do have limited time, so I will try to get it through as much as I can. And we'll go through pivots, volatility windows, and also if we have enough time to look at some real time, because that's what we all want to look at, what's going on right now. And also, we'll try to save some time for questions. So I'll try to answer some questions during the presentation, and also make sure have them at the end as well. So do you use 3-day pivots to use overnight sessions? So the 3-day pivots, yes, they're applicable to the overnight session, and both, even the intraday pivot, are applicable to the overnight session. So you'll see when you apply those, you'll see the market will have reactions to those in the overnight. So good question. Now going to volatility windows, these are only for the cash trading session. So it's based off of the opening range, and volatility windows offer a level for the market to trade within and create a bias for an expansion or set a trap, like what we had today. Half of the time of the opening range is needed to establish a bias. Once a bias is established, the market can only reverse the bias. No other bias can be made. We'll look at that. So for example, a hold, so if the opening range is 10 minutes, then half of that time is needed above the upper volatility window in order to establish a bias. And the reasoning for the time is that you can run into the upper volatility window and even break through that and then come right back down. The question is there enough demand that the market can hold above that resistance level to show that there's underlying demand? And that's where the time comes in. So if it's able to hold for half of the opening range above a volatility window, it establishes a bullish bias, and pullbacks, buyers are lured in on the breakout, and they're also forced to defend pullbacks into the opening range because they want to control the trend of the day. And the last level of defense, once a bullish bias is established, is the reversal window, which is just under the opening range. And again, to reverse that bias, or to reverse the bullish bias, it needs to be a 5-minute hold below the open. So think of it like this: the market opens, breaks through the upper window, the buyers have the upper hand, comes back to the open, the buyers are supposed to defend that. If it loses the open, who's in trouble? It's the buyers, right? So we'll look at a lot of different examples too. And the same thing with the lower volatility window. If it breaks below the lower window, it establishes a bearish bias. Sellers are forced to defend rallies to the open. And in order to trap the sellers, you got to get through the opening range to trap those shorts. So after establishing a bias, the volatility windows becomes first level of support or resistance for the bias to be defended down to the opening range. And the last line of defense is that reversal window to hold the bias for the day. So hold through the reversal window for half of the opening range is needed to reverse the intraday bias. This is what catches the session on the wrong side, kind of what creates traps, and it gives way to expand that in the opposite direction. So a bias can be established sometimes just to lure in traders to set a trap and turn it right down. So a failure to see continuation sets those traps, and that's, we did have that today. And I'll show you. You can see the screen share. This is today's action really quickly. You can see the market gets through the upper volatility window, establishes a bullish bias, comes down into the open where you get this big fight. The buyers try to defend the open. Once the reversal window was lost, the buyers from the session are caught on the hook, and it gives way for a little bit of a liquidation down. But let's go through step by step. So the first thing is a bullish bias expansion. So the opening range that I use, a lot of people use different opening ranges to get that out of the way. Some people like to use, on the floor, they use like 1-2 minute opening ranges, very smaller time frames. Sometimes they'll use 5. I like to use a 10-minute opening range, and on different markets, they have different ranges. So for example, on crude oil, it's the first half hour. For the S&P, it's the first 10 minutes. So in order to establish a bias, it needs to be half of that opening range, so it's 5 minutes. So if we see the 10-minute chart or bullish bias expansion example, you can see the first 10 minutes is highlighted. That's the open. And these are the pivots. You can see the overnight got through the pivots. The cash market squeezes off the pivots. These are the volatility windows, the solid lines. Gets through the upper volatility window. There's a little bit of a reaction down, but it gets through, holds above to establish a bullish bias. This lures in longs. Now for them to get paid, they need to defend that volatility window. That level becomes the first level of support. If that fails, it's back down to the open, and the reversal is just below the open. So in order to reverse that bias, they would have to lose the opening low. So as long as the market holds above its upper volatility window, it gives you the idea that the pressure is to the upside, and the buyers have the upper hand, and they can try to squeeze it and expand it into the close. So if you're trying to fade that, just think you're getting in front of the freight train. So it gives you, the vol windows give you a story for the day or an idea of what the flow is. If you get, again, a bullish bias that it's above a window and it holds above that window, then the pressure is to the upside. If this window is lost, then there's room to test the open, which is where the buyers would want to defend to try to prevent this from turning into a reversal. So another example of a bullish bias expansion, you can see the open gets a chop, falls down into the pivot, which catches the move through the opening high, into the upper volatility window, a little bit of a pullback, and then through, establishes a bullish bias. They can't get it to expand right away. get a little bit of a pullback below that vol window, and then this is the test of the open. So that vol window turns into a little bit of a resistance, but they're defending the open, and as long as those buyers defend that open, they're in control. The bias for the day is bullish. They recover the upper volatility window. It gives them room to run into the close because the sellers could not break it lower. The sellers are on the hook. The buyers control the day. They defended the open. So again, when the bias is established, I don't necessarily get long right away. I look at, it gives me the idea to buy pullbacks. And if I'm looking to be a contrarian, then I'll look at the bias to be established and the market to pull below the volatility window. So those buyers get trapped and I'll sell the retest. We'll look at that. So the open is 9:30 in New York, 8:30 in Chicago. So we use the New York open, Chicago cash open, New York. Okay, this is bullish bias reversal window defended. This was what happened last Wednesday. If you guys remember, last Wednesday, the market opened negative. It opened below its prior close, which was 27.24. It was a gap down. It was a big squeeze on the open. It's through the upper volatility window, establishes a bullish bias, lures in longs, also stops out shorts, runs into its pivot, runs into its prior close at 24, so it meets a lid, it gets rejected down, and then that turns into a trap. And you can see the retest, the buyers failed to overcome that volatility window, because think of it, these are buyers caught on the hook. For them to get paid, you got to overcome this vol window and expand it higher. If there's supply that's caught above that and they're unable to overcome that, and you can also combine this with footprints, whatever you're looking at, if you see supply that's trapped at that, and a retest of this, you want to see obviously buying balances as well, where buyers are piling in and they're unable to overcome that. That turns into resistance. That's where the contrarian would look at defending, and then you get a pullback down to test the reversal window. Now what we talked about is when you have a bullish bias, the reversal window is the last level of defense for the buyers to hang on to the trend for that day, for the bullish bias. And that's what we saw last Wednesday. We pulled down into the reversal window. They held that, got a little bit of bounce, and it came down for a retest, which held on lower volume. Offers lifted. They got it back through 27.10. These shorts got trapped, who were looking for new lows on the day, and it's still above the reversal window. So they got hooked. They got stuck there as they couldn't take out the cash lows. Grinds up. Once it recovers the upper volatility window, the buyers from the earlier session recover, and we get that close above. And you remember what happened on Thursday is we opened above 27.30. It was a gap up, leaving the shorts from this session trapped. And then what happened last Friday was another gap up with a big squeeze, because the shorts from last Wednesday got trapped when they couldn't expand it down here. But the sellers were never able to take out that reversal window. So it's, even if you have a bias for the day that's bullish, pullbacks into that reversal window is the last level of defense to try to defend the momentum. It also gives you kind of you're kind of closer to the exit if you're buying that weakness. But as it sets up a bullish bias, again, the buyers, they're forced to buy the pullback. So they buy the pullback into the open, they're buying the pullback into the reversal window, so they're loading up. And for them to unload, it has to hold below that reversal window for 5 minutes. So sometimes when you want to get the market to move in the opposite direction, is you'll set a trap like this just to force everyone to buy the weakness, and you sell into those bids, and then you have a massive trap that gives way to an expansion down. And we'll look at some reversals as well. But this one, you can see they recovered into the close, held on to the bullish bias, and that expanded on into the next day, Thursday and Friday. So this is a bullish bias with a reversal into the close. So this is when we get through the upper volatility window, establishes a bullish bias. You can see the pullback into the vol window turns into support, makes a new high, comes down, retests that high, and they can't expand it, pulls back to that vol window, get a little bit of a fight, falls back below, and then now who's trapped? The buyers above the volatility window are on the hook, right? You get, now they're forced to defend the open, get a dip down into the open, they defend that, they can't get it up through the vol window, another dip into the open, defended, another dip down to the reversal window, it's defended, they get it through the upper volatility window, they try to overcome, hold on to that bullish bias, just like here, they try to hold on to that bullish bias and close above that, and they fell, and it closes below that reversal window. This leaves these buyers trapped. So this was a retest. And you can see here, this was a massive fight to try to defend the opening range because the bias for the day was bullish, so they're buying these pullbacks, but they couldn't get through here. And then finally over here, they got through that. They probably squeezed out some shorts with stops above these highs and then closed it below the reversal window. So when you have a close below, when the market goes out into the close below its open, it's a reversal into the close. What that means is all the longs that defended it here and got stuck above this are now on the hook, and it gives room to expand this 2680 to 2725 range down. And that would take place into glowback. So this would give way because now all the buyers from this session are caught on the wrong side. And you'll see that on the next day, the 228, you can see, so the prior low here was 2680. If we look at the next day, you can see that 2680 was right there. So in the overnight, it did fall down in 60s. Got to move down. The open falls down into the lower volatility window. You got a big fight to try to defend that, but the pivot and the open is defended. The buyers could not overcome the open. If they can't overcome the open, they're stuck below 2680, which means the market is trapped under the prior session low, 2680. So the buyers from the prior session are trapped. The buyers from the current session are unable to overcome that. Once it gets below the lower volatility window for this day here, it establishes a bearish bias. That vol window turns into resistance, and then you get your expansion down into the close. The bears run with it below the lower volatility window. And who do you have as fuel to fuel the move down? Is you have the buyers that were trapped above 2680 from the prior session. They're forced to liquidate as this goes down. So sellers are forced to press the market below 70, and then buyers are forced to liquidate because they're stuck at higher prices. So we'll look at another bearish bias expansion. In this case, we have the pivots here that are providing support, and it gave way for a bounce to the upper volatility window, but you got a rejection. It's also a low risk area for sellers to defend that because what they need is a 5-minute hold above to reverse that bias. So the first test of the upper volatility window is defended. You get to move down below the lower volatility window, establishes a bearish bias, and you see the bounce to the open is to be defended by the sellers. So when you have a bearish bias, they have to defend the bounce into the open. And it was defended. We got another move down into a new low, bounces back to the volatility window now that was broken. That holds up as resistance. They defend that. And as long as it's holding below the lower volatility window, the sellers are in control, and it gives room to expand it down. Okay, because what the buyers need is to overcome the vol window and the reversal window to trap the shorts. As long as the sellers defend the open, they're in control of the session. And another bearish bias expansion, we see the market get into, now this is, so if anyone remember this date, May 6, 2010? Okay, you can see the pivots are right there at 1164. And you can see the pivots are very tight. Now again, when you have tight pivots, it means the prior day was indecisive, and again, it gives room to see an expansion or volatility to expand. So in this case, you can see the market rallies into the upper volatility window and pivots. It's unable to get through that, and it falls down, takes out its lower volatility window, establishes a bearish bias. You get a bounce to stop out some early shorts, tests the open, unable to get through the open, back below the volatility window, the sellers are in control, and it gives them room to expand it down. So you see this is 1144, and we go into the next slide, and this is how it looks. So you can't see this coming, and if you look at the daily back then, there was head and shoulders that was projecting 1134, so this was the actual target. Everything below that was the crash, right? So you can't predict when the market is going to crash, but you can see signs of weakness or cracks in the market, like a failed retest or a head and shoulders or a bull trap. But you can see here when it established the bearish bias, you get the bounce. They're unable to get through the open, and then the bears control it below that lower volatility window. And it expands down, you get the flash crash and bounce back. But a very tight pivot here gave way for this volatility expansion because the prior day was very indecisive. You had a very tight pivot, and it allowed for a breakout of the range and an expansion. So in this case, we're going to look at a bearish bias with a reversal window that's defended. So remember, when the market establishes a bearish bias, sellers pile in below the opening low, and now they're forced to defend the open up to the reversal window. Okay, so you can see that here. We squeezed, chopped, held here, keeping shorts on the hook, squeezed it up into retesting the opening highs and the reversal window. The buyers are unable to overcome the highs of the day. If you get through that, you leave the shorts from the session trapped and you can expand it up. But the buyers are unable to overcome that. You see the sellers defend the rally back into the opening high, and then back below the lower volatility window, the sellers take back control and they expand it down. So in order for the sellers to be in control, they got to be below this vol window. Sometimes you'll get like this when it makes a new low, the sellers pile in, but then it chops its way back to the open. And again, for me, if I'm using this, I'll look at a bearish bias. The bounce into the open is resistance. That's an area I'm either going to look to defend, or the market has to get through in order to squeeze the short side. This was a bearish bias, reversal into the close. This was last Thursday. Remember, with the gap up? So remember, last Wednesday was the test of 2,700 that held, and we closed up. Thursday, we gapped up. Volatility windows, just really quickly, it's proprietary calculation that I use, is based off of the opening range. Pivots, and they give an area above and below the market to trade within. Break out of the range is needed to establish a bias, which is what we're looking at. And pivots are like anything else. You use the last, whatever session you're using, the high-low close to get your pivot. And then in this case, so we're looking at biases now. How do we establishing biases? This is a bearish bias with a reversal into the close. So remember, we looked at a bullish bias where the market closed below its reversal window and extended it the next day. In this case, we have a bearish bias with a reversal into the close. So the shorts, you can see they broke the lower volatility window here, establishes a bearish bias, rally into the open is defended, they get another move below the vol window, it turns into another trap. Every low was turning into traps on this day. On last Thursday, it was a gap up. So you do need to mind where the gaps are, and I'm going to try to get to that as quick as possible so we can look at the cash. We can see, even though it established the bearish bias and the sellers were defending the open, every rally was sold into, the sellers could not gain any traction down. Now here, it made the new low by 50 cents, and it squeezed right back up to the vol window. It came down for the retest. It gave sellers a chance to try to make a new low. When they couldn't, you get your offers lift back in through the vol window. Sellers below this are trapped. You get a squeeze, taking out the series of lower highs and through the opening high, holds above the reversal window for 5 minutes, which means it reverses its intraday bearish bias. Once the bias is reversed, what does that mean? Is the shorts below that volatility window are trapped. And you can see it managed to fall all the way down and retest that. And this is why I call it get out of jail free card, because if you're short below 27.28 and you see the market squeeze and make a new high, well, when it comes back to your price, you're trying to get out. And that's what creates demand, because the shorts are bidding to cover. And if it's a good trap, it's not going to spend a lot of time because it's going to touch it and run away. And by doing that, it leaves the shorts trapped here. And by closing above the reversal window, the shorts are trapped, and it gives room to extend this into the next day. And you remember what happened last Friday is we had a gap up, and then we opened at 27.60, and we rallied up to 27.90s last Friday. So it was a big squeeze last week, but it was all fueled by this squeeze, by this trap, retest, and then the close up. So traps short, it lures in shorts, below that vol window. When they can't get it to expand down, they get caught, and they're used as fuel. Because it's all about, you know, fueling the market in one direction or the other. That's how you get the market to move, is by having buyers turn into sellers and sellers turn into buyers. In this case, we have a bullish bias that's reversed. You can see the market values into the upper volatility window, can get through on its first test, comes down to test the lower volatility window, which cannot get through on the first test, gets through the upper volatility window, holds above that, establishes a bullish bias, and you got the pivots above, which are acting as resistance here. So the buyers are unable to hold above that vol window. Once it falls below that, you can see the open is defended. Here, they're defending the open, and they get another shot to try to overcome that vol window. When they can't do so, those buyers above that are trapped. So you can use this, you know, how you use it. You know, the way I like to use it is I like to see if, you know, for example, if I'm looking at selling the market, or if I'm looking at being a contrarian, I do want to see a bull bias created, because that can give buyers an opportunity to expand to see if they can break out of the range, but also creates opportunity to create a trap like this. So if I see a bullish bias like that and it's rejected, then I look at selling the retest, because I know I have a reference point. This is where the exit is. If it makes new highs on the day, I'm out. But I know that if these buyers are not able to overcome, they get trapped, and it gives room to expand it down. So that's playing it contrarian. Continuing with the trend is you want to defend that open. You can see defended the open, vol window is defended. By failing to overcome that vol window, the buyers are trapped. You get another push down to test the open. And again, the buyers fight to defend that, and they're unable to push up. You get another swing below the reversal window. Once it holds below this, you have the bias is reversed, and you get expansion to the close. A bear bias reversal, you get a market break below the lower volatility window, establishes a bearish bias, gets through the reversal, the shorts are trapped below the lower volatility window, and that gives you your fuel to expand it up. You can see after the bias was reversed, it didn't give shorts much of a pullback to get out on a retest. It just left them trapped, and it grinded up into the close. Bullish bias reversal, when it establishes a bullish bias, again, falls below that lower volatility window. You can see the reversal window was defended. They try to bounce it. It bounces 10 handles. It's just a reaction, because the buyers are defending that. Once they lose that, the buyers lose the opening low, and these are trapped, and it gives way to expand it down. Another bullish bias reversal. This was February last month. We had that big move down, and it was created with the market breaking above its upper volatility window, establishing a bullish bias. You had you move down into that reversal window, which was defended, and then once that reversal window was taken out, this is this day right here. Once the reversal window was taken out, all these buyers are trapped, and that fuels the downside. So all these buyers are trapped. You can see we made a new low, bounce back to that reversal window, turns into resistance, leaving the buyers from that session trapped. And you take that range, you subtract that from the downside, and it gives you your objective. And that's where the crash came in again. But this was luring in buyers, forcing them to defend the open, selling into them, and then trapping all the buyers from that cash session, as this turned into resistance, and you get your expansion down. You know, so how you can use this is you identify the trap, or you look to defend that bias. Once the bias is lost and the reversal is made, then you're looking at selling rallies. 3-day pivots are very important. I look at these to give me an idea of what the trend is. So we have about 15-20 minutes in this. I'm trying to try to get through as much as possible. You can see 3-day pivots. When the 3-day pivots are below the market, they provide support for the buyers to defend. You can see here the pivot was very tight, the 3-day pivot, because we had an indecisive range here where it was chopping. Even though it was holding the 3-day pivots, it was not really expanding up. You had a very tight 3-day pivot, and we had an expansion up. The next day the market falls into the 3-day pivot. There was a big tug of war to try to defend that, but there wasn't an expansion up, so the buyers couldn't continue their trend. It closed below the 3-day pivot, which showed an indecisive period, and that created a very tight pivot for the next day, and the market broke. So when the market falls into the 3-day pivot and it doesn't bounce, it shows the 3-day pivot is there for the buyers to defend. If they can't get it to bounce, it shows that there's not that many buyers at that level, and there's also an opportunity to reverse the trend. You can see once we reverse that, the 3-day pivots turn into resistance, and the trend was down. And when you close through the 3-day pivot, the 3-day pivots turn into support again. You can see that here. They're below the market. They're acting as support. You can see here again, there was a U-turn. The bears got trapped here. Very tight pivot for the next day, which means it's an opportunity to break out of this range. And you can see what happened right here with that tight pivot. It broke out of that range, falls into the pivot, couldn't get a bounce. Another tight pivot the next day, catches a lot of bounce, and then the expansion down. Once the trend is reversed by converting the 3-day pivots above the market, those turns into resistance. You can see that here. Once we trade through the 3-day pivot, they turn into support again. See that here, see that here. Over here, it doesn't come into the 3-day pivot, so it doesn't give buyers a chance to defend. Friday, non-farm payroll bounces right off the top, gets up, and then recently, right now, on Tuesday, it fell into the 3-day pivot, and it couldn't catch a bounce, which shows that the buyers were unable, there wasn't any demand here. They all got stuck above Monday's low. Monday's low turns into resistance, and you can see yesterday's 3-day pivot was very tight, and that's what gave way to that volatility. You had a rally up, and it closed right back down. And where's today's 3-day pivot? So it was right here, and it acted as resistance for today. So it's an attempt, and we'll look at quickly just today's. You can see the screen share here. You can see the screen share. Today's 3-day pivot, we rallied into that, found resistance, turned lower, but it couldn't take out the low from the overnight. So tomorrow's 3-day pivots are above the market. In order to attempt to reverse the momentum, they need to close above that 3-day pivot, because the rallies into that range is an area for the sellers to defend. So quickly, cup and handles or reversals. You'll see a lot of these, but just the way you look at them. So the way you look at them is where the market started, where it fell down to, and where it recovered. So when it falls down, it's shaking out longs. When it squeezes up, it's stopping out shorts. Then you got your period of consolidation, which creates the handle. That's kind of the shell shock. When the longs and shorts get kicked out by consolidating, it keeps it forces the buyers to have to pay back up. Then you take your range and you add that to the top. And the reason why we have that is because you can see once we completed this target here, was right here. The following day, we had to move up and right back down, leaving the late buyers above that trapped. And you can see once we took out this, there was another massive trap that developed here, giving way for the liquidation that we saw last month. And what does it fall? All the way back to the inverted head and shoulders from November. You can't really see it here, but this was an inverted head and shoulders. And you'll see that in the next slide right there. Is the inverted head and shoulders. You have your first low, a new low, which the sellers failed to expand, followed by a bounce. The retest that gives the opportunity for the sellers to expand down. And if they can't, they get stuck, get through the neckline. It gives room to expand it up. And that was about here. And it went all the way up to there. So that was the retracement all the way back to that November breakdown. Other stuff, inverted cup and handles. Cash is very important to take a look at, because this is what it will show you. For example, last month in February, when the bull trap was created from the State of the Union, the market gapped down the next day, and it fought to hold that for 3 days, but it couldn't overcome this gap. And by not overcoming that gap, it left these buyers trapped. The next day, you get a gap down. These buyers are trapped, forces liquidation down. February 5th, we had a gap down, rallied up, which was the bullish bias into a reversal down. And then you can see we came all the way back to the February 5th range, consolidated, squeezed that high, which was 63, stopped out the shorts, reversed that down, no new buyers show up, and then create this handle. So these buyers that bought the breakout got stuck, and that created the inverted cup and handle that gave you a move down. And then when you have another reversal like this and a chop, again, this is another opportunity to expand that up, which is what we had recently with the market rallying up into 2707 on Monday or Tuesday, but it couldn't overcome this high from February 2nd, 2707. There's a gap right there at 22. There's supply above that that's trapped, and that's what's created resistance. So recently we've kind of turned this right back down creating another U-turn, and we retraced right back to where we were last Thursday. Which is so last Thursday was the move up was fueled by shorts being squeezed. So when we come back to that, now it's opportunity to look to see if there's any new buyers after the shorts get squeezed, because the shorts fueled the move up. Now it's up to new buyers to step up. If you get new buyers, they get an opportunity to push it back up. If the new buyers are not able to hold this level, then it shows there's still more supply that's caught above. And that's usually how bear markets go, because you get shorts that squeeze the market and they sell right into them. So we're going to look at volatility windows on a 6-month basis. The year is divided into 2 halves. The first 2 weeks is the opening range. And in order to establish the biases, you need a hold for 5 daily closes. So this is a bearish bias that's a trap. So if you remember in January or February of 2016, we were looking for new highs on the year. And the way we're looking at that is we saw the market broke below its lower volatility window. It established the bearish bias, but the sellers couldn't expand and it got a V bottom. When you get your V bottom and a bearish bias, you take that range, it gives you room to expand it up. But this is opposite of what we had this year. This year, we had a run up to start the year. In 2016, we had a run down, so the break of the lower volatility window turned into a trap. So it was a leg down. When it broke that vol window, it established the bearish bias. It lured in the late sellers, and they got trapped, and that gave way to expand it up. You can see once we got through the reversal window, it turns into support. Shorts are trapped. It gives way to expand it. You make new highs on the year. And now you have a U-turn and a cup and handle on a larger picture. Looking at the bullish bias continuation in the second half of 2016, broke through its upper volatility window to establish a bullish bias on a 6-month basis. You can see the pullbacks into the reversal window is defended. Couldn't get through the upper vol window to expand it. They're waiting on the election. 3 daily closes, not 5. You have a wick down on election, back up, recovers the upper volatility window, and you got your called a bull flag, expand up into the close, which is what we had, expand up. So the first half of the second half of last year, again here you can see, establishes a bullish bias, expands up into the close. Establishes a bullish bias on a 6-month basis, expands up into the close. And then this is what we had this year, where you can see the last second half is established. So we had all these bullish biases fuel the move up, and what fueled this move down is the break, just like the 2016 when we had that chase to the downside. In this case, we had a chase up. And when we broke the upper volatility window, this is when we lured in buyers. And as it fell back below that vol window, they're forced to defend that reversal window. So they're forced to bid it up. And as you get a flush like this, all those longs get sold into, and 5 daily closes below the reversal window reverses the bullish bias. So the bias for the first half of this year is now a reversal, and that's why you're seeing rallies being sold into. This was sold into, this was sold into, this is sold into, and we held, pushed back, and now this is the attempt to recover the buyers that are trapped above 2,800. So this is key. If it can overcome 2,800, it can try to target the stops above this, the monthly high of February, 2,837, to give another opportunity to retest the high of the year. If it holds below 2,800, the buyers stay trapped above that, and that gives room down. And you can also see a U-turn here. Now it's this period right here where they either expand it up or fail, and then you get your move down. This is considered the neckline. You have an early high, a high, and this is the neckline. So a bullish bias reversal in the mid caps. You can see it held above the upper vol window just long enough to establish a bullish bias, lure in buyers, breaks below the reversal window, traps those buyers, catches the flush all the way back to where the market broke out in September, bounce back into that reversal window, first level of resistance, catches the move down, back through that. Now it gives room to try to test that volatility window if they can overcome that bull trap. But the first test of that is resistance. Have to get through the reversal window down to try to expand it down, otherwise turn to support, push back up. You can see in the second half of last year, it broke below the lower volatility window, established the bearish bias, gets through the reversal window, and it used those shorts to fuel the run up last year. And this year, it's using the longs to fuel the run down. Okay. One thing we quickly want to look at, I wanted to show you, is the Dow Jones. Very similar. You know, we'll look at the volatility window in the Dow Jones. It was right there. You can see establishes a bullish bias, traps those longs, and you can see the retest of that trap turn into resistance, and we had a lower high. So this is going to be key to overcome to recover those longs. So now this is showing a head and shoulders formation on that failed retest. So you see that here, the bull trap, down, failed retest, and then this is the retest of this high. So the buyers are going to have to overcome this high to get another shot at overcoming the failed test from last month on the 27th. And there's supply that's trapped above that from January. That supply turns into resistance. I will look at, this will finish it up, but we'll look at, and then we'll look at some questions. Crude oil, if you guys remember in 2016, if you follow the Twitter at Chicagostock, because if you remember back in 2016, the market was very bearish, and we said there's a failed breakdown, there's an opportunity to see a squeeze. And what I was looking at is when the market took out its lower volatility window, again, you had a big move down. So when it took out its lower volatility window, it had an opportunity to create a trap, because when it bounced back up, you have another V bottom. That turns into a failed breakout, and it breaks above its upper volatility window, establishes a bullish bias, and you can see it expands up, and the second half of the year it breaks lower vol window, establishes a bearish bias, and that was used to fuel up. You can see that turned into a trap because it held here, closed up, and then another bearish bias, got to defend with this low, and then the second half of last year it establishes a bullish bias, bounces off that vol window, and expands up into the end of the year. And now where we're at is we're just stuck inside of this volatility window for this first half of the year. Tested the upper vol window, couldn't get through. Tested the lower vol window. The bears got stuck below that, and we're back to testing the open. So got to break one side or the other. So it's still neutral. Break below the lower volatility window is needed to establish a bearish bias and to try to expand it back down. Okay, so I'll try to go over some questions that I see, and I would love to spend as much time on this as possible, but our time is limited. What do you trade off of, Globex chart or cash chart? Which one do you take entries from? I take entries on the Globex Globex chart, but what I look at is I look at the cash because, example, last week when we had this V bottom, and remember last Wednesday the market opened down, that was a negative open. So this was a negative open. We rallied up to test the prior close that turns into resistance. So when we have a negative open, it tells me rallies are supposed to be sold because the buyers are trapped from the prior day. So we saw that defended, and it came back down. When it couldn't take out the low and we closed back up, shows that the sellers were unable. And the next day when we opened higher, we had a gap up, and that gave me an idea that I should be looking at buying weakness. So I look at where the gaps are because that tells me who's trapped. When you have a gap up like that, you know the shorts are trapped below 2730, and the pressure is to the upside. So if I'm selling that, I'm going against the momentum because I'm kind of selling into here, and you have people who are stuck short who are bidding to try to get out, and you're selling into that demand. And you see we closed on the high on Thursday. And where do we open on Friday? We opened with a gap up. Whoever that did not cover on Thursday, they were forced to cover on Friday. So I look at the cash because it gives me an idea of where the gaps are. For example, Monday we had a gap up, came down, and they couldn't overcome. Tuesday, another gap up, which was when the gap's up, it gives the buyers an upper hand to try to expand, and they couldn't. They dropped the ball. Yesterday, another gap up, they dropped the ball. And now, today, we had another gap up in which they dropped the ball and filled this gap. So you can see here, this is like a U-turn, and this is this chop that we're going through right now. So the buyers got to get through this 70 level to try to retest the bull trap that was set on Tuesday to try to overcome that. If tomorrow we open below today's low, what that tells me is that the buyers are still stuck above this breakout of this prior high, and these buyers from today that fought to defend this gap around the hook, and that gives me that where the pressure is to the downside. So if we open below today's low, tells me pressure is to the downside. If we open above where we closed, then the buyers get another opportunity. So it's good to look at the cash, where the cash opens, if there's any gaps, because it gives you an idea of the gaps. You can see the gap here, because when it opens below, you got to look at who's trapped on. Try not to be trapped yourself, because the traps is what fuels. When you have an open lower, the buyers from the prior session are caught on the hook, and it forces the sellers to chase, to sell into the hole. And that is what gives way for the break. So you can see here a bear trap, because they failed to expand and it reversed right back up. So that turns into a bear trap. So the volatility windows are, you can use them to apply. I've been using them for close to 10 years, and I wouldn't go without them, because futures are a 24-hour market, and you got to look at where the market opens, where the pivots are, and the volatility windows give me an area above and below the market that it has to get through to try to break out of this range, to try to establish a bias for the day, whether it's a bullish bias or a bearish bias. If I'm coming in on a day and I see it's a negative open, and the market is trying to squeeze shorts that are selling into the hole, then I'll look at seeing what the reaction is over the upper volatility window. I'll look at to see if they establish a bullish bias, and to try to use that as a trap. So everyone can use the volatility windows in their own way, whether they want to defend the trend or look at traps being set, but they tell you the story of the day, and they give you the reason, kind of like the color behind that day, whether it's a bullish bias, bearish bias, where the rallies are to be sold, and who's being caught on the different sides. And the pivots are, for me, very important to use. I use the pivots to look for resistance and support during the day. And the 3-day pivots, like we looked at, will give you support and resistance on a rolling period. So if we look at the 3-day pivots for the S&Ps that we were just looking at for today, you can see today's 3-day pivot was above the market. And by being above the market, it means it's an area for the sellers to defend and for the buyers to overcome. So when the 3-day pivot is above the market, it gives you the idea that the pressure is to the downside. And in order to overcome that, you have to close above the buyers have to overcome the resistance, close above that, so that the next day the pivots are below. Perfect example is right here. On the 4th, you get a close above the 3-day pivot. It reverses its downward momentum. Then your 3-day pivots for the following days are below the market, and they provide support to try to trend it up. So you can use it in how you want to use it, but it can give you an idea of what the trend is, what the momentum is. If you get the market to close below the 3-day pivot, then it shows that it's starting to stall out, where it may try to change its trend. When the pivots tighten up like that, it gives you idea that there could be volatility expansion or a breakout of the range. And you can see a very tight pivot here after failing to bounce on Tuesday off of the 3-day pivot. So they couldn't continue that trend, tight pivot, and that is what turned today's pivots above the market, because it changed the trend. So now going forward, tomorrow's 3-day pivots are above the market again for an area for the sellers to defend. Now, if we end up closing through that 3-day pivot, then the shorts who came in below 62 are on the hook, and that gives room to retest Monday's high. So it's ping pong. The market is testing levels where it can try to get through, test levels, see if there's supply and demand, they can push through, and it's just that battle that's taking place during the day, and want to try to identify who's caught on the wrong side. So that's what the volatility windows is ideal for and helps for. So if you would like to check out the volatility windows, we offer them on an intraday basis. You can get them daily, the ES, the NASDAQ, crude oil, and gold. If you click this link here, I believe if you click it, it'll give you, the link will work. So you get 2 weeks free trial. Within that 2 weeks, you can take a look at it, and it includes the daily S&P 500 analysis. And you can continue after that, or you can cancel. But 2 weeks for free. And the 6-month volatility windows are given every 6 months. So the next 6-month volatility windows are in July. We already have the 6-month vol windows for this half of the year. Indices, metals, energies, currencies, grains, and treasuries. And we saw how they're applied on a 6-month basis for a larger picture. If you're swing trading, position trading, get an idea of what the overall picture is. And if you're looking at, we are also offering for NinjaTrader, if you use this code, NinjaTrader, it's a 30% coupon on, get access to all this and screen sharing where you can follow real-time charts and trading and join our trading room. So see what I'm actually doing in real time. When I put a trade on, it goes through the chat room, offered at this level, 4-point stop, 3-point stop, whatever it may be. And at the same time, you can see the trade working on the screen. So you don't have to take me for my word for it. You can see it going in real time. You can see my adjustments in real time, if I'm scaling, if I'm stopping out, whatever it may be. But you can see the transparency because I'm showing you my screen with the charts and trades on there. And I wish we had more time. But we are grateful for the time that we had today. I'm appreciative that you guys joined today. We went through a lot of material today, so I wouldn't expect to kind of absorb it right away, but this is archived, so you can go back to it and look it over again, look at the slides as far as the different patterns and the different kinds of volatility windows that can be established. And I want to thank, if you have any questions, email contact@chicagostocktrading.com. Website is chicagostocktrading.com. And follow us on Twitter @chicagostock. You can check out a lot of periscopes and charts that I'm actually posting on there.
Cool. All set for me to wrap up, Stewart?
Yeah. Let me just take these questions really quick. So we'll work on any other platform. So yeah, the volatility windows and pivots, you can plug them in on any platform. I like the charts that NinjaTrader offers, guys, and plug them in right there. But obviously, you can plug them into anything. It's just manually plugging them in. And what is that course? The course is where I'm at. So this course is I go into in far depth. I've created a proprietary strategy where it actually identifies where the entry level is, where the stops are. So it's more into detail as far as what the actual trading is. And it's that if you want more information on that, send the email. And we do those once a month. We have classes, and we can try to get registered for the next one that comes up. And yes, it'll work for NinjaTrader 8, definitely. Okay, and thank you again. Thanks, everyone. Jared, thanks, and I'll hand it over to Jared. You guys, thank you.
Awesome. I want to give a special thank you to Stewart Solaka of Chicagostock for his great presentation today. Everyone in attendance here today will receive an on-demand recording of today's event via email. That'll come out in the next probably 1 to 2 days. NinjaTrader Ecosystem is pleased to sponsor these weekly events as a value-added service for our clients. If you find value in these events, we hope that you'll attend on a regular basis. We'll put a link in for upcoming events that we're going to have. So check that out if you want to attend some more classes. We want to remind everyone that the information provided in this was that of was that of Chicagostock and not of NinjaTraders. All information was for educational purposes and should not be construed as trading advice. Again, we appreciate the time you spent with us today. Please enjoy the rest of your day. We hope to see you again in future webinars. Happy trading from all of us here at NinjaTrader Ecosystem.